alta, sorry, and the cons is the first. So, and we try to understand how, for example, we can test this capital asset pricing model. So suppose that we are taking account for n securities I, where we can say that n is equal to 50 or whatever, 100, and we can suppose to hold this security for 5 periods. Okay? So holding for 5 periods. So this means that if I want to estimate, if I want to if I have to calculate all the returns that I need to test this model, I need to calculate 50 returns for 5 periods, for 50 stocks. So 50 stock return for 5 periods, and then what I have the risk-free rate that I need, and I need also the return of the market. So if the way that I can proceed to test whether the assumption of the capital asset pricing model holds in the reality, I can proceed in this way. First of all, I define this regression, where I can calculate the excess return of the stock I minus the risk-free rate at the time t because I have more than one holding period. This is equal, we can say, so we take, this is the definition of our model, is equal to alpha plus beta, the excess return of my market portfolio plus a component that is firm specific. So what I can do, I can estimate alpha and beta. I can also, what I can do, I can also calculate the variance of my firm specific component of risk. And then, so it is simple, I can do through a regression. So I can calculate, this is what we also saw this morning, alpha, beta, calculate then the variance of my residual. So what I do then, I can compute, so I can calculate for each stock the average, so the return of the stock I minus the risk-free rate. And for the index, I can also calculate the average return, the average excess return of my market portfolio. So then, if I what I can do, I can estimate my security market line using my N observation that I have here, my N security, in a second regression, where what I do, I just regress this quantity, this excess return for gamma 0 plus gamma 1 multiply this guy here that is my coefficient. If the capital asset pricing is valid, what I should find that this quantity is equal to 0, and then that my gamma, so that I can get through my estimation, should be equal to what? Should be equal to the excess return, the average excess return of my market portfolio minus the risk-free rate. So what I do here, I estimate alpha, I estimate beta, I substitute here my beta, I just do the average, I calculate the excess return of my stock, average excess return of the stock I, and then I run a second regression, where if this is odd, I should expect that this quantity is equal to 0. Why? Because we said that if the capital asset pricing model should only reward the systematic risk component of risk. So no alpha, no let's say free lunch, something like that. This quantity, if the model also should be equal to this gamma here to just what I was able to calculate. So the excess return of my market portfolio management free and the average. Remember, this is, as I said, remember that the capital asset pricing model is only rewarding the systemic risk, and I shouldn't have any, it should be independent of any non-systematic component of risk. Then the non-systematic component of risk, we know based on what we saw this morning, can just relating to the variance of my residual. And I could have calculated, so in this first stage, after I have run in my regression, I estimated alpha, beta, but I also was able to calculate the variance of my residual. So what I do? I put also this quantity in my regression. So this is a number, because I calculated this. This I estimated before. This I can calculate this difference for each stock. So now I want to estimate this model where if the capital asset pricing model is true, this quantity should be equal to 0. This quantity gamma 1 should be equal to the market risk premium. And these guys here should be equal to 0. Why? Because I shouldn't get any relationship between the average return, excess return of my stock with respect to the specific component of risk. Shouldn't alter, shouldn't be there, if the model is valid in the reality. Why? Because as I said, this is a model that do not price the non-systematic component of risk. So this specific component of risk should not be significantly related to, statistically related to these guys here. Should be something that, on average, do not explain this difference here. So I ran my regression, and again, and this is, for example, what Linger have done in 1965. So he followed this procedure. He estimated beta, he estimated alpha, he estimated the variance of specific component of risk. He substituted this information in a separate regression and he rerun the analysis again. So if you check this coefficient here, do you think that what do you think? Is the capital, based on this experiment, does the capital asset pricing model as a model to pricing hold or not? Or I find some contrasting results? So we said the capital asset pricing model should define a price that only reward the systemic component of risk. So if I design this second equation where this is the return of my stock, okay? This is a component that is not explained by systemic risk, because do you see any, is not relating to anything. It's just something, a return that the stock should give you for free, not relating from risk, any risk. It's just a constant. So constantly, a stock give you money. And we said that by assumption, a stock cannot give you money for in this way. If you gain money, it's just because you are taking risk. This is what the model tells you. So by assumption, this quantity should be equal to 0. Then, this is the beta that we estimated before. We should find the coefficient of this second regression if beta is already catching the sensitivity of my stock to the market reward, my gamma should be equal to the market reward. Okay? Because the capital asset pricing model is like this. It's like is what we have here. It's this is what you should get. Plus beta plus, as you can see there, you have the expected increment. This is what we defined before. No? So as you can see here, these guys, I can bring these guys back here. Okay, and this is what I have here. So let's say this is like in our example. Okay, these I bring here. Then what I have here is beta minus these guys here. That this quantity here we can call gamma 1. We know beta because we estimated beta using this regression. So in this regression I can estimate beta, and I can also calculate this variance. So if this is, I don't know if you can see that. So basically, this is my gamma 1. So what I should expect is that if I look at this, if I want to, what I should expect here is that this is what I should get in my results. So only this guy should explain the excess return of my stock. And gamma, since beta, I already estimated beta with the first regression, my gamma must be equal to the excess market return. So, since I want to make sure that really the model is pricing the systemic risk, what I do, what the previous researchers have done, they built a new equation here where they said, okay, this component should just be equal to these guys here. Let's try to verify whether there is some sort of reward or gamma that can be positive or whatever. So if there is some, let's say, gamma that is, so there is some return that is not explained by this guy here. So what they said, okay, let's add this, estimate this coefficient. Remember the intercept. Do you remember what the example of this morning? Food expenditure and income. Even though your income is equal to 0, because you're a student, you spend money on food expenditure. So I want to try to understand if the excess return of the market is 0, do I get still some money? Based on the capital asset pricing model, all the money that I get should be relating to the systemic risk component. So if this, I shouldn't have these guys here. Plus we said the capital asset, the assumption of the capital asset pricing model, these are assumptions. So this doesn't mean that they work in the reality. The assumption of the capital asset pricing model is that you have a very well diversified portfolio. And we know that diversification means sorry? Someone is praying. Are you praying? Because I cannot hear anything. You are just speaking by yourself. I don't know. What? What does it mean, diversification?
Lower risk.
Sorry? Low risk, yes, but which risk I can diversify? So this means that if I estimate for those stock, if I'm able to calculate, to measure the specific firm risk that is equal to this component here, these guys here shouldn't have any impact on this. So the coefficients of this guy should be equal to 0, because this component should on average. Because this guy shouldn't explain these guys here. So these are the results that they found. So based on these results, do you think that they found the results consistent? So the hypothesis is that gamma 1 is equal to the excess return of the market, epsilon 0 must be equal to 0, and epsilon 2 shouldn't be significant, equal to 0. Okay? So if I look at these results, because we said epsilon 2 is the gamma 2 is the relating to the relationship between firm specific risk and return of my stock I. So if I look at these results, are these results supporting capital asset pricing model? Yes or no? Why not?
Because gamma 0 gamma 2 are not 0.
As your friend said, the assumption is gamma 1, why are not 0 or average? Are not significantly different from 0. If you repeat the experiment are not significant, that you will get are not significantly different from 0. If you repeat n times the experiment, you will get something that is 0, on average equal to 0. So the number here doesn't tell you anything somehow. Because if you repeat the experiment many times, changing, you will get that the guys is equal to 0. Why? How can I say that these guys are not significantly different from 0?
Because gamma 1 is actually...
No. Look at the table. There is not one word. Why this guy is 0 and the coefficient is not significantly different from 0? What I should look here? Sorry, but this statistic, if you do, well, I will show you the next time, but as I said, if you are not familiar with econometrics, just have a look at the slide chapter 3 that uploaded. T is higher than 2. When T is higher than 2, this means that the coefficient is not significantly different from 0. So my assumption is that the two coefficients are significantly different from 0. Instead, so my assumption is that these two guys, gamma 0, gamma 2, should be equal to 0. But since my T statistics is higher than 2, this means that I cannot say the true value, so that if I repeat the experiment, I will never get something equal to 0. This is a value that is different from 0. So I cannot say, based on this experiment, I cannot say that this guy is equal to 0, and I cannot say that this guy is equal to 0. This means that this difference, so the return of the excess return of the stock I depends on firm specific risk and some constant. So that is not relating to the systemic risk component. So, but in this is an experiment that was done in the 1965. Of course, there are some problems with this experiment. Why? Because using the first and second pass methodology, so in the first regression I estimate beta and the variance component. Then I substitute here, the other point here is that if you look at the coefficient of gamma 1, we said the gamma 1 should be equal to the historical market risk premium. Okay, because I estimated beta, so I want to get gamma 1 equal to this guy. And you can see they are pretty different. So this is why I also examine it. So the problem with this methodology that in the first regression, first of all, I don't know what the true market value is. Because the capital asset pricing model just spoke about a generic market risk, but I don't know what the market risk is. I just use proxy, stock market index. But the stock market index just a proxy, just a way to measure the market portfolio, but is we don't know if it's not just a measure of it, but it's not a true market portfolio as told in the theoretical model. Then in the second, investor cannot borrow the risk-free rate as assumed by the capital asset pricing model. We discussed many times, one of the assumptions of the capital asset pricing model is that you borrow, lend the money at the risk-free rate. But if you go to the bank, nobody will borrow the money at the risk-free rate. So this is an assumption that do not really hold and affect these results. And the other reason is that when I estimate beta, do you remember we saw this morning, there is always some sort of error. And as the error is smaller, more is precise, more my prediction is reliable. But this error that I get in the first analysis when I estimate beta, then I bring this error in the second equation, and this is going to affect somehow these guys here. Okay, I stop here these slides because I think it's better if I will catch up this part the next time. So we finish this block, and then if you can bring now we just finished the case studies on gold, and the next time we will finish this part here. Please have a look at these slides, have a look at the stuff that I scan from other book and I put on and I uploaded in Dropbox. And then have a look at chapter number 3 of please linear regression, because so you can read the slides, understand these statistics better. Okay, then we will do some analysis the next time, but I cannot explain you. I mean, I will check with you, but if you don't know the linear regression stuff, so just use it. Okay, so let's take the no, but it's not my module. I made a mistake, I'm sorry. Because this module is 6221, so it's a mistake. I'm sorry. And so what we do now. Sorry, the exercises that I will sorry, I say something, but you asked me a question on the exam. I said that theoretical questions come up in the form of multiple choice questions, something similar to what we have. We will do some multiple choice questions also the next time, but we already have done some multiple choice questions the last time. Then I give you exercise, and you have to do the exercise that I give you at home. Okay, so now there are some exercises we will do the next. Now there is no time, and we will do the next time. I will finish the slides. We will do the exercise on capital asset pricing model together. So I don't upload any solutions for the capital asset pricing model because we will try to do the next time together, and then we will do the case study together. So read the case study in advance. So. So here, if you remember, the last time we just arrived to design this efficient frontier. Oh guys, 5 minutes and then I leave you, really, because I was tired. So here, what we have to do, we have to just so basically what we have to do, we just need to answer question number 8 and number 9 of the case study. So what we have done right now, we try to understand, so this is how you could also proceed if you have to create your portfolio. You try to understand the property of your assets. So in this case, we know that gold has some property in terms of hedging from inflation, is skewed, positive skewed. We know that has a low correlation with other assets. So we try to understand how including this specific asset in our portfolio can affect the return and standard deviation of my stock, of my portfolio. So what we have done, here we are using Markowitz, so we are using historical data. We just took, in this part here, the monthly average return, annualized. And what we have done, we try to understand for US bond, US large cap and gold, what we try to understand how fixing different target standard deviation with the possibility to invest or not invest in gold, we try to analyze what was the expected return of my portfolio. And we know that if you want to build the efficient frontier, there are two ways. One, fix the standard deviation, targets and maximizing the return, or fixing the return, minimizing the standard deviation. In general, what I want to do, if you have to do some analysis at home and you use daily data, it's very difficult to get a positive return. So it should be better to use monthly data because it's allow you to clean some noise from the daily data. What you can also do if you want to do some simulation, I uploaded some paper yesterday, 3 days ago, where there is the expected return of and the expected premium for each asset. So what you do, there are researchers that ask to academic and to professional, to people that invest money for job, what is the premium for each asset. They collected all this information and they create a sort of benchmark, a sort of guide where they tell you what is the premium from investing in each asset. Usually what academics do is using this premium to do optimization stuff. So one possibility is to use the data, monthly data, daily data, if you have a very short time series. So here what we have done, we have designed the two frontiers, with and without gold. And we saw that without gold, my frontier is lower. Someone asked me, if I want to calculate the minimum variance portfolio, if you want to calculate the minimum variance portfolio, and there are many assets, what you can do, you should basically what you should do, you should basically do an optimization problem using the Lagrange. So if you are interested, but I mean you need to have a software that allows you to, let's say, sort this stuff here. What you have here, yes. The Lagrange So you try to sort out and get it. Oh guys, 5 minutes. Believe me, I'm more tired than you. And I also more bothered than you. So here, basically, if you want to identify, because remember, if you want to get a minimum variance portfolio, you need to find the quantity to invest in my portfolio that make my variance the minimum possible. We have a look at the minimization process using 2 stocks in our slides. If you have more than 1 stock, what you have to do, you have your constraint, and in this case is the sum of the weight equal to 1, and you have each main equation as much as you have stock, because you need to identify the way to invest in each stock, 1 and stock. So if you are interested in this, I upload some slides where I will explain the Lagrangian with some example and also solution. And there is also a book, a page of the book where I show you the formula of the Lagrangian for our problem. So you can get the steps and you just need to follow the process. So to finish the case study, 2 minutes. So here is the question is, of course, people invest in gold, and usually they invest in gold or alternative in commodities. Why? Because also commodities, as you can see, gold is below real assets. Investment in real assets allows you to cover from inflation, so a good hedging for inflation. And we know that gold can be used as a hedging purpose for inflation. So if you, and I will give you the solution, if you can just, in this example, apply the Excel solver, you can see how having gold or not having gold change the composition of real assets. If I don't invest any money in gold, so the investment in gold is 0, as you can see, the optimum portfolio where I have 11 assets will include money invested in US rates, investing in real assets or commodities. If instead allow my portfolio to also have gold, I can sort out my optimization process. That is 1 minute, then the other lecture will keep me. So if you change this parameter and you allow also to invest in gold, what you will get, as you can see, now in this optimization I allow my portfolio to have weights in each 11 stock. And as you can see, gold absorbs entirely the weights of commodities. Before I had some money that I could have invested in commodities, now is equal to 0. So is gold, can we use gold as an alternative investment of commodities? Based on this example, yes, because if I allow my portfolio to have both gold and commodities, gold absorb all the weights that before I had in commodities. Now commodities is equal to 0. And the reason of this, if you check the correlation matrix, the commodities is basically has, if you look at the correlation, yes, it has some correlation with gold. This means that eventually there is some relationship between the commodities, so the performance of commodities and gold. So eventually the 2 assets for hedging purpose for inflation can be one alternative investment. What I can see from here that we finish, that if you assume the return of gold 1 for 80%, what you notice idea that if you assume a different performance return of gold, so I assume the return is 1, then is 4, then 8, and I do my optimization process, the weight of gold is the same. So looking at these results, what I should notice that the return of gold, so even the return of gold is very high, the money that I should put based on this optimization process on gold are the same. So what I should get from this picture that the investment is in gold is especially convenient not to increase the return of my portfolio, but it's convenient to get gold especially because it allows me, given the property of to diversify my portfolio because it has a very low correlation with the other assets, and eventually I don't increase too much the return of my portfolio because, as you can see, the weights of gold are the same even though the return of gold is 1/8, and as you can see, the benefit that I get in terms of return of my portfolio is really marginal increase, even though here was the double the return of gold. So having gold is profitable not a lot in terms of return, so it's convenient not for increasing the return of my portfolio, but to reduce the risk of portfolio given the properties of low diversification with the other assets. If you have questions, you can ask me the next time. Finish. See you the next week.